There is a fear that lives inside every person who has ever put a dollar of their hard-earned money into the stock market. It's a primal, cold feeling that surfaces when the headlines turn grim, when the tickers on the screen bleed red, and when the confident pronouncements of analysts curdle into whispers of uncertainty. It is the fear of the crash, the fear of waking up to find that the value of your life's savings, your retirement, your dreams for your family has been cut in half or worse. This fear is rational, it is powerful, and for 99% of people it is the single greatest obstacle to building real, lasting wealth. It causes them to sell at the absolute bottom, to lock in devastating losses, and to swear off investing forever, just as the greatest opportunities are beginning to surface. But for one man, this universal fear is transformed into something else entirely. For Warren Buffett, the Oracle of Omaha, the sound of a market crash is the sound of opportunity knocking. It is the dinner bell, signaling that the banquet of a lifetime is about to be served. While the world panics, he becomes greedy. While the world sells, he prepares to buy. He does not see the red on the screen as a loss of wealth, but as a once-in-a-generation sale on the world's greatest businesses. This is not because he is reckless, or because he has a crystal ball. It is because for over 70 years, he has operated with a playbook, a set of mental models and ironclad principles that transform the market's greatest peril into his greatest advantage. He has engineered a system that allows him to turn widespread financial terror into personal financial triumph. And the central beating heart of that entire system, the single thesis upon which his multi-billion-dollar fortune was built, is this: when a truly great company is hit by a major, but ultimately temporary crisis, the market's predictable, emotional overreaction creates a once-in-a-lifetime buying opportunity. This is the principle that separates the amateur from the master, the victim from the victor. And today we are going to deconstruct that playbook, piece by piece. We will not just admire his success, we will reverse engineer it. We will install his operating system into your own thinking, so that the next time the storm comes, you will not be running for shelter. You will be walking out into the rain with a bucket, ready to catch gold. This is the final promise of value investing. This is how you get rich when everyone else is losing their mind. The first and perhaps most overlooked pillar of Warren Buffett's crisis investing playbook has almost nothing to do with picking stocks. It has nothing to do with analyzing balance sheets or predicting earnings. It is the foundational element upon which the entire strategy rests, the bedrock that makes everything else possible. It is the unwavering discipline of building and maintaining a fortress of liquidity. Before you can be greedy when others are fearful, you must have the ammunition to act. You must have cash, not just enough to get by, but a veritable mountain of it. A strategic war chest held in reserve for the precise moment when bargains are no longer just attractive, but screamingly cheap. This principle seems counterintuitive, especially in the throes of a raging bull market. Every financial guru, every talking head on television will tell you that cash is trash, that it's a melting ice cube, losing value to inflation every single day. They will urge you to be fully invested, to put every last dollar to work so you don't miss out on the gains. And for the average person, this siren song is irresistible. But Buffett operates on a higher plane of financial reality. He understands that cash has a hidden value that doesn't appear on any spreadsheet. It has option value. It is a call option on the future, on the certainty that at some unknown point in time the world will lose its mind and assets will go on sale. And when that day comes, the person holding the cash is not the fool, they are the king. The greatest illustration of this principle in modern history unfolded in the autumn of 2008. The global financial system was not just cracking, it was disintegrating. Lehman Brothers, a titan of Wall Street with a 158-year history, had vanished into bankruptcy. AIG, the world's largest insurer, was on life support from the federal government. The credit markets, the lifeblood of the entire economy, were frozen solid. Fear was no longer a sentiment, it was a physical, palpable force that had seized control of the world. Banks didn't trust other banks. Companies couldn't get loans to make payroll, and the stock market was in a state of freefall. It was, by all accounts, financial Armageddon. And in the middle of this chaos, in his quiet office in Omaha, Nebraska, Warren Buffett's phone began to ring. He wasn't making calls, he was taking them. He was not a seller, he was the only buyer. On Tuesday, September 23, 2008, the call came from Goldman Sachs, the most prestigious investment bank in the world. The firm was not in immediate danger of failure, but its stock was being hammered by rumors and a crisis of confidence. They needed more than just capital. They needed a vote of confidence from the most trusted investor on the planet. They needed the Buffett seal of approval. And Buffett had what they needed: $5 billion in cash. But he wasn't going to just give it away. He negotiated a deal that was, for him, almost risk-free and breathtakingly profitable. He wouldn't just buy common stock. He would invest $5 billion in preferred stock that paid him an immediate, guaranteed 10% dividend. That's $500 million a year, every year, like clockwork, from one of the best financial institutions in the world. On top of that, he received warrants giving him the right to buy another $5 billion worth of Goldman's common stock at a fixed price of $115 per share at any time in the next 5 years. Goldman's stock was trading around $125 at the time, but Buffett knew that when the panic subsided, it would be worth far, far more. He was being paid handsomely to wait. Just over a week later, on October 1st, another giant came calling: General Electric, the quintessential American industrial conglomerate. GE was facing its own crisis of confidence, primarily in its massive financing arm, GE Capital. They needed to shore up their balance sheet, and again, Buffett was the only one with the capital and the credibility to do it. The deal was remarkably similar. He invested $3 billion in GE preferred stock, also paying a 10% annual dividend, $300 million a year. And again, he received warrants, this time to buy $3 billion of common stock at a strike price of $22.25. Think about the power of this position. While the rest of the world was watching their retirement accounts evaporate, forced to sell their best assets to meet margin calls, or simply out of sheer terror, Buffett was deploying billions of dollars not as a speculator, but as a lender of last resort. He was acting as a private central bank. He could do this for one reason, and one reason only. He had spent the preceding years, the bull market years of 2005, 2006, and 2007, accumulating cash. While others were chasing the last few percentage points of a bull run, Berkshire Hathaway's cash pile grew and grew, reaching over $44 billion by the end of 2007. He was criticized for it. Analysts said he'd lost his touch, that he was too conservative. But Buffett wasn't being conservative, he was being patient. He was building his fortress brick by brick, waiting for the inevitable storm that he knew would come, even if he didn't know when. When it finally hit, his cash was not trash. It was the most valuable asset in the world. The deep psychological reason why most people fail to do this, why they find it nearly impossible to hold cash, is a powerful cognitive bias known as present bias, often coupled with its close cousin, hyperbolic discounting. Our brains are wired for immediate gratification. We are the descendants of ancestors who had to seize any available resource immediately, because tomorrow was never guaranteed. An apple in the hand today was worth far more than the promise of 2 apples next week. This ancient wiring is still active in our modern financial lives. Present bias makes us dramatically overvalue immediate rewards and undervalue future rewards. When the market is going up, the reward of seeing our portfolio tick up by another % today feels intensely gratifying. The abstract, future reward of having cash available for a hypothetical crisis years from now feels distant and weak. Hyperbolic discounting is the mechanism that makes this happen. The value we place on a future reward decays not linearly, but hyperbolically, meaning it drops off very steeply in the short term. The allure of a 10% gain this year feels infinitely more powerful than the potential for a 50% gain in some undefined crisis year in the future. This is what fuels the fear of missing out, or FOMO. As we watch our friends or neighbors get rich on tech stocks or cryptocurrencies, our present bias screams at us to get in on the action now. The pain of being left behind today is far greater than the imagined pain of being caught without cash in a future downturn. Holding cash in this environment feels like a constant, nagging, low-grade punishment. You are actively choosing to forego the immediate pleasure that everyone around you is enjoying. Buffett's entire approach to liquidity is a conscious, disciplined, and systematic override of this fundamental human impulse. He has trained his brain to invert the pleasure-pain calculus. For him, the pain of missing a potential future bargain is far greater than the pain of underperforming in a bull market. The pleasure he derives from the security and optionality of his cash fortress far outweighs the fleeting pleasure of chasing a hot market. He isn't thinking about the reward he can get today. He is thinking about the incredible, life-changing reward he can get when the world offers him a deal that is overwhelmingly skewed in his favor. He is willing to look foolish for years to be able to act brilliantly for a few crucial weeks. It's a psychological discipline that is as rare as it is powerful, and it is the absolute prerequisite for crisis investing. So how can a regular person, a retail investor or an entrepreneur, apply this principle without having billions of dollars at their disposal? The blueprint is a practical mental model called the two-bucket liquidity strategy. It's a way of structuring your finances and your mindset to build your own personal fortress of liquidity, scaled to your own life. The first bucket is non-negotiable. It is your emergency fund. This is the foundation of all financial security. It should contain a minimum of 3 to 6 months' worth of essential living expenses. This money is not for investing. It is not for buying the dip. This is the money that ensures you will never be forced to sell your quality assets at the worst possible time to cover a personal emergency, like a job loss or a medical bill. A market crash often coincides with an economic recession, making this bucket the firewall that protects your entire financial life. This money should be kept in the most boring, safest, and most liquid place possible, a high-yield savings account. It is your sleep-at-night money. The second bucket is the one that transforms you from a potential victim into a potential predator. This is your opportunity capital fund. This is your crisis cash. Its purpose is singular, to be deployed when a major market dislocation occurs. The size of this bucket is more personal. It might be 10%, 20%, or even 30% of your total investable assets, depending on your risk tolerance and age. For a younger investor, it might be smaller, while for someone nearing retirement who wants to protect capital, it could be larger. The key is to decide on a percentage ahead of time and stick to it. This capital should also be kept safe, but you can be slightly more creative than a simple savings account. Short-term U.S. Treasury bills or a high-quality short-term bond fund are excellent options as they provide a slightly better return than cash while maintaining high liquidity and safety. The real work of this model is not mechanical, but psychological. You must build a mental wall around this opportunity capital. During a bull market, you will be tempted to chip away at it. You'll see a stock you like go up 20% and think, I could have made a quick profit. You must resist. You must tell yourself, this money has a different job. Its job is to wait. A practical trick is to give it a specific name in your banking or brokerage account. The 2028 Crash Fund, or the Buffett Fund. By labeling it, you assign it a mission, making it psychologically harder to raid for other purposes. This disciplined approach is the core of effective, long-term wealth management and the first concrete step towards true financial freedom. To truly appreciate the genius of this approach, we must examine its opposite. We must walk the path of the 99%, the path of the fully invested fallacy. Let's imagine a typical, well-intentioned retail investor in 2007. Let's call him Mark. Mark is smart, he reads the financial news, and he's seen the market go up for 5 straight years. He's fully bought into the idea that cash is trash. His portfolio is 100% in stocks. with a heavy concentration in the hot technology and financial stocks of the era. He might even be using a little bit of leverage through a margin account to magnify his gains. He feels like a genius. Every month, his statement shows a higher number. He's beating the S&P 500. He tells his friends at barbecues about his stock-picking prowess. He has completely succumbed to the FOMO and present bias we discussed. His financial freedom seems just around the corner. Then, 2008 happens. The market begins to slide, then it lurches, then it plummets. Mark's portfolio, once a source of pride, is now a source of constant, gut-wrenching anxiety. It's down 20%, then 30%, then 40%. The stocks he loved, the ones with the great stories, are the ones falling the fastest. He gets a margin call, forcing him to sell some of his positions at catastrophic losses just to cover his loan. The psychological pressure is immense. Every instinct screams at him to sell everything, to just make the pain stop. He holds on as long as he can, but one day, after a particularly brutal drop, he capitulates. He sells everything, locking in a 50% loss on his life savings. The feeling is one of bitter relief. Now, here is the true tragedy. In late 2008 and early 2009, Mark starts to see incredible opportunities. Stocks of world-class companies, the bluest of blue chips, are trading at prices not seen in a decade. He knows intellectually that this is the time to buy. But he can't. He has no cash. All his capital is gone, crystallized into a permanent loss. He is a spectator, paralyzed on the sidelines, watching the sale of a lifetime pass him by. He not only failed to protect his capital, but he also lost his ability to take advantage of the crisis. His adherence to the fully invested mantra, which made him feel so smart during the boom, led to his complete and utter ruin during the bust. He ignored the reality of market volatility and paid the ultimate price. This is the fate Buffett's strategy is designed to avoid at all costs. The direct financial connection between holding cash and generating superior returns becomes crystal clear when you look at the numbers. During a bull market, holding a significant cash position will, by definition, create a drag on your portfolio's performance. If the S&P 500 returns 20% and 10% of your portfolio is in cash earning 1%, your overall return will be lower. This is the cost of the insurance policy, but its value is realized in the crash. Let's quantify the Buffett deals. His $5 billion investment in Goldman Sachs paid him $500 million in dividends each year. By 2011, when Goldman redeemed the preferred shares, Buffett had collected over $1.5 billion in dividends alone. He then exercised his warrants. He bought $5 billion worth of stock for $115 a share at a time when the stock was trading far higher. His total profit on the Goldman deal alone exceeded $5 billion. The GE deal was similarly lucrative, generating hundreds of millions in dividends and over $1 billion in profit on the warrants. This wasn't just beating the S&P 500. This was a level of capital gains that is almost unimaginable for a public market investor. The cash didn't just prevent loss. It was transformed into a tool that generated extraordinary low-risk returns precisely because it was deployed when no one else had any. Consider the financial statement of Berkshire Hathaway. That cash pile sits on the balance sheet, a massive asset listed as, quote, cash and equivalents. To an undisciplined investor, it looks lazy, but to Buffett, it is potential energy, a coiled spring. Its presence allows him to negotiate terms that no one else can get. He isn't buying shares on the open market like a retail investor. He is recapitalizing entire corporations. The financial impact is a dramatic skewing of the risk-reward profile of his entire enterprise. During the good times, Berkshire might slightly underperform a roaring market. But during the bad times, it not only protects capital far better, it plants the seeds for the next decade of outperformance. That fortress of liquidity is not a drag on returns. It is the very engine of Berkshire's long-term compounding machine. It is the first and most critical component of turning a market crash into a wealth creation event. Once you have built your fortress of liquidity, the next critical task is to know what to buy when the storm arrives. It's not enough to have cash, you must have a shopping list prepared in advance. A market crash is not a time for leisurely research. It is a time for decisive action. And Buffett's shopping list consists of only one type of item: a truly great business. But what does great actually mean? For Buffett, the definition is precise and unwavering. A great business is one that is protected by a deep, wide, and sustainable economic moat. An economic moat is a durable competitive advantage that protects a company from competitors, much like a moat full of alligators protected a medieval castle. It is this protective barrier that allows a company to earn high returns on capital for very long periods of time. Identifying these moats before a crisis is the second great pillar of Buffett's strategy. It's the work you do in the calm weather that allows you to act with confidence when the hurricane makes landfall. This focus on enduring quality is what separates true investing from mere speculation. You are not buying a ticker symbol. You are buying a piece of a superior business that you believe will survive and thrive long after the temporary panic has faded. The foundational anecdote that best illustrates Buffett's evolution towards this moat mentality is not a dramatic crisis investment, but a quiet, landscape-changing acquisition that happened in 1972. It was the purchase of See's Candies. At the time, Buffett was still largely operating under the cigar butt investing philosophy he had learned from his mentor, Benjamin Graham. This approach involved finding deeply troubled, statistically cheap companies that had one last puff of value left in them. It was about buying fair companies at wonderful prices. But his partner, Charlie Munger, was relentlessly pushing him toward a different, more powerful idea: buying wonderful companies at fair prices. See's Candies was their first major test of this new philosophy. See's was a family-owned box chocolate company based in California. It was not statistically cheap. The asking price was $30 million, and Buffett initially valued it at a much lower number. The company had tangible assets, factories, stores, of only about $8 million. From a pure cigar butt perspective, paying a premium of over 3 times the book value for a candy company seemed ludicrous. Buffett was ready to walk away. But Munger persisted. He saw what wasn't on the balance sheet. He saw the moat. The moat was the See's brand, an intangible asset of immense power. For decades, See's had built a fanatical customer loyalty in California. People associated See's chocolates with holidays, with romance, with celebration. Giving a gift of See's was a social signal of quality and good taste. This powerful brand gave See's something extraordinary: pricing power. Each year, the company could raise its prices slightly to cover inflation and then some. And the customers didn't blink. They happily paid up because the emotional value of the product far exceeded its monetary cost. Munger convinced Buffett that this durable brand loyalty and the resulting pricing power was an asset worth paying for. They ultimately negotiated the price down to $25 million and bought the company. It was a turning point. See's Candies became the prototype for Buffett's moat-focused investing. The company required very little additional capital to grow, and it gushed cash year after year. Since 1972, See's has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, on an initial investment of just $25 million. It taught Buffett that the most valuable assets are often the ones you can't see on a balance sheet: a powerful brand, a loyal customer base, a trusted reputation. These are the foundations of a true economic moat that can withstand recessions, competition, and the test of time. The psychological principle that makes these economic moats so powerful is rooted in a cognitive shortcut our brains use called the availability heuristic, which in this context creates what we can call brand salience. The availability heuristic states that we tend to overestimate the importance of information that is easily retrievable from our memory. Things that are vivid, recent, or frequently encountered seem more true and more valuable than things that are abstract or rare. A powerful brand, like Coca-Cola, Apple, or See's Candies, is the ultimate beneficiary of this heuristic. Through decades of advertising, ubiquitous presence, and positive personal experiences, these brands have carved out a privileged, easily accessible space in our collective minds. When you think of a refreshing beverage, Coca-Cola instantly comes to mind. When you think of a premium smartphone, the image of an iPhone appears. This mental availability, this brand salience, creates a self-reinforcing psychological moat that is incredibly difficult for a competitor to breach. A new soda company can't simply create a product that tastes slightly better. It has to spend billions of dollars over decades to even begin to compete for that same mental real estate. This psychological lock-in gives the incumbent company enormous advantages. It creates customer loyalty, reduces their marketing costs, and, most importantly, grants them the pricing power that Buffett prized in See's candies. Consumers are willing to pay a premium for the certainty and familiarity of a trusted brand. It's a cognitive shortcut. Rather than analyzing every possible option, we simply choose the one that feels safest and most familiar. This is why, even during a brutal market crash when the stock of a company like Coca-Cola might get hammered, the underlying business is remarkably resilient. People around the world don't stop drinking Coke because the stock market is down. The psychological moat protects the business fundamentals, even when the stock price is reflecting temporary panic. Buffett's genius is in recognizing that this intangible psychological advantage translates into very tangible, predictable, and long-lasting cash flows. So how can an ordinary investor identify these moats? The key is to use a practical mental model, a structured approach I call the 4-moat identification checklist. This is the blueprint for analyzing a company's competitive advantage. Before you ever consider buying a stock, you must be able to confidently check at least one of these 4 boxes. The first moat is intangible assets. This is what See's Candies had. It includes powerful brands, patents that protect a product from being copied, like a pharmaceutical drug, or regulatory licenses that are difficult to obtain, like a railroad's right-of-way. To identify this, look for evidence of pricing power. Does the company consistently raise prices without losing customers? Look at its gross margins. Are they consistently high and stable compared to competitors? This indicates the company isn't just competing on price. The second moat is high switching costs. This exists when it is too expensive, time-consuming, or risky for a customer to switch from one product or service to another. Think of the software that runs your business's entire accounting system. The cost and disruption of switching to a new provider would be immense, even if the competitor is slightly cheaper. To spot this, look at customer churn rates or retention rates. If a company keeps over 95% of its customers every year, it likely has high switching costs. The third moat is the network effect. This is one of the most powerful moats, and it's common in technology platforms. The network effect occurs when the value of a product or service increases for every new user that joins. Think of a social media platform like Facebook or a credit card company like Visa or MasterCard. A credit card is more valuable to you if more merchants accept it, and it's more valuable to merchants if more consumers have it. This creates a virtuous cycle that locks out new competitors. To find this, ask, does the user experience get better as the user base grows? If so, a powerful network effect may be at work. The fourth and final moat is a cost advantage. This is when a company can produce its goods or services at a consistently lower cost than its rivals. This can come from immense scale, like Walmart's purchasing power, a unique process, like Toyota's manufacturing system, or access to a unique, low-cost resource. This allows the company to either undercut competitors on price or earn higher profit margins. To identify this, compare the operating and net profit margins of the company to its closest competitors over a long period. A consistent and significant margin advantage is a clear sign of a structural cost advantage. This checklist provides a systematic way for any retail investor to move beyond simple stock picking and start thinking like a business analyst, which is essential for any successful stock market strategy. To fully grasp the importance of the moat, we must examine the antithesis, the dangerous allure of chasing story stocks and hype. This is the path most investors take, and it almost always ends in disaster, especially during a market crash. A story stock is a company with a captivating narrative, but no discernible economic moat. The story is often about a revolutionary new technology, a massive untapped market, or a visionary CEO who is going to change the world. These stories are exciting, and they attract investors who are more interested in the thrill of the narrative than the boring reality of business fundamentals. The dot-com bubble of the late 1990s was the golden age of the story stock. Consider a company like Pets.com. The story was brilliant. We're going to use the internet to disrupt the massive pet supply industry and deliver dog food directly to your door. The company had a catchy name, a famous sock puppet mascot, and a soaring stock price. Investors poured hundreds of millions of dollars into it. But where was the moat? There were no intangible assets. The brand was brand new and had no real loyalty. There were no switching costs. A customer could buy from Pets.com one day and a competitor the next with a single click. There was no network effect. And most importantly, there was no cost advantage. In fact, they had a massive cost-tentas disadvantage because shipping heavy bags of dog food across the country was incredibly expensive, often costing more than the product itself. Pets.com had a great story, but it was a terrible business. When the market crash of 2000 arrived, the investors' sentiment that had propped up the stock evaporated overnight. The company, which had no profits and no protective moat, quickly ran out of cash and went bankrupt, wiping out all of its shareholders. This is a timeless lesson. Whether it's internet pet supplies in 2000, speculative biotech firms, or any number of high-flying tech stocks today, companies without a moat are incredibly fragile. Their stock prices are built on a foundation of hope and narrative. When a market crisis hits, that foundation turns to sand, and the entire structure collapses. The disciplined investor, the one focused on portfolio growth for the long term, learns to ignore the siren song of the story and focus exclusively on the durability of the moat. The direct financial connection between an economic moat and a company's financial performance is unambiguous. You can see it printed in black and white on the income statement and balance sheet. A wide moat company will consistently exhibit financial characteristics that a no-moat company simply cannot replicate. The most important metric is return on invested capital, or ROIC. This number tells you how much profit a company generates for every dollar of capital that has been invested in the business. A company with a strong moat can consistently generate a high ROIC, often 15% or more, because its competitive advantages protect it from the profit-eroding forces of competition. A no-moat company in a highly competitive industry, like a commodity airline, will struggle to earn its cost of capital over the long run. Let's compare the financials of a classic wide-moat business like Moody's, the credit rating agency, with a major airline over a 20-year period that includes the 2008 financial crisis. Moody's has a powerful moat built on intangible assets, its trusted brand, and regulatory acceptance. Airlines operate in a brutal industry with high fixed costs, intense competition, and no customer loyalty. Looking at their financial statements, you would see that Moody's consistently reports gross margins above 70% and operating margins above 40%. The airline, in contrast, would have gross margins closer to 20% and operating margins that swing wildly, often turning negative during recessions. During the 2008 crisis, the airline would have posted massive losses and seen its balance sheet crumble. Moody's, while its stock price certainly fell, would have remained highly profitable, continuing to generate strong free cash flow. This financial resilience is the direct result of the moat. When you buy a company with these characteristics during a market panic, you are not just betting on a stock price recovery. You are betting on the recovery of a superior business whose financial strength will allow it to weather the storm and emerge even stronger as weaker competitors falter. This is how you achieve the kind of long-term capital gains that truly lead to financial freedom. You buy financial fortresses when they are temporarily on sale. You have now built your fortress of liquidity, and you have your shopping list of wide-moat companies. The crisis hits. The market is in a full-blown panic. Now comes the moment of truth, the point where most aspiring value investors fail. It is the execution of the third pillar, understanding and exploiting the madness of Mr. Market. This is perhaps the most famous of all of Buffett's mental models, inherited from his mentor Benjamin Graham. The concept is simple, yet its implications are profound. You must learn to think of the stock market not as an all-knowing, rational arbiter of value, but as a manic-depressive business partner named Mr. Market. Some days, he shows up at your door euphoric, offering to buy your shares from you at ridiculously high prices. On other days, like during a market crash, he shows up in a deep, inconsolable depression, terrified of the future, and offers to sell you his shares at absurdly low prices. The key, Graham and Buffett teach, is that you are always free to ignore him. You are not forced to trade at his prices. His mood should not be your mood. You should use his manic highs to consider selling, and, most importantly, use his depressive lows to buy. This pillar is entirely psychological. It's about mastering your own emotions by personifying the market's irrationality. It is about having the mental fortitude to separate the volatile price of a stock from the underlying value of the business and to act decisively when the two diverge to an extreme degree. The quintessential story of Buffett exploiting Mr. Market's madness is the American Express salad oil scandal of 1963. It was a crisis that struck at the very heart of a company's reputation for trust and financial prudence. A small subsidiary of American Express was in the business of warehousing, and one of its largest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino De Angelis. De Angelis had devised a massive fraud. He had taken out huge loans from various banks, using his inventory of salad oil, stored in American Express's warehouses, as collateral. The problem was, the inventory was a phantom. The giant storage tanks were mostly filled with water, with only a thin layer of oil floating on top to fool the inspectors. When the fraud was discovered, Allied Crude collapsed, leaving its lenders with worthless collateral. The market reacted with sheer terror. The central question was whether American Express would be held liable for the losses of the banks that had lent money against its warehouse receipts. The potential liability was enormous, running into the tens of millions of dollars, a figure that threatened to wipe out the company's entire net worth. Mr. Market fell into a deep, dark depression. He was convinced that American Express, one of the premier financial institutions in America, was facing bankruptcy. The stock price was annihilated, plummeting by more than 50% in a matter of weeks. This was the moment of peak panic, peak uncertainty, and therefore, peak opportunity. While Wall Street analysts were frantically trying to calculate the maximum legal liability, the young Warren Buffett did something different. He went out and did on-the-ground research. He wasn't focused on the stock, he was focused on the business. He went to restaurants. He went to banks. He talked to merchants. He wanted to know one thing. Had this scandal damaged the core businesses of American Express, its travelers' checks and credit cards? He observed that customers were still using the cards. Travelers were still buying the checks. The brand loyalty, the company's true economic moat, was completely intact. The public either didn't know about the salad oil scandal or, more likely, didn't care. They trusted the American Express brand. Buffett concluded that the salad oil problem, while serious, was a temporary, survivable, and quantifiable hit to one division of the company. The core franchise, the engine of its profitability, was unharmed. Mr. Market, in his panic, was throwing the world-class baby out with the fraudulent bathwater. Convinced of this disconnect between the market's perception and the business's reality, Buffett acted with incredible conviction. He invested 40% of his entire investment partnership's capital into American Express stock. It was the single largest investment he had ever made. Over the next few years, as the company settled the legal claims for a fraction of what the market had feared and its core business continued to grow, the stock price soared. Buffett's partnership made a fortune. He had faced down Mr. Market's deepest despair and was rewarded with one of the greatest investments of his early career. The underlying psychological principles that create Mr. Market's wild mood swings are primarily herd behavior and the affect heuristic. Humans are social creatures, and for millennia, our survival depended on sticking with the tribe. This instinct is still deeply embedded in our brains. When we see the herd moving, in this case, selling stocks in a panic, our instinct is to run with them. There is a feeling of safety in the crowd, even if the crowd is running off a cliff. To stand apart, to buy when everyone else is selling, is an act that feels profoundly unsafe and unnatural. It triggers a deep-seated fear of being ostracized and left behind. This is the engine of bubbles and crashes. The affect heuristic is a mental shortcut where we make complex decisions based on our current emotional state. In a market crash, the dominant emotion is fear. The headlines are scary, the red numbers on the screen are scary, and the feeling in our gut is one of dread. When an investor thinks about a stock like American Express during the salad oil scandal, the affect heuristic bypasses rational analysis. The thought of the stock is associated with the feeling of scary and bankruptcy. The decision becomes simple: sell the scary thing. Buffett's superpower is his ability to consciously short-circuit these psychological traps. He cultivates an extreme form of emotional detachment. He doesn't see the herd's panic as a signal of danger. He sees it as a signal of opportunity. He actively suppresses the affect heuristic by forcing himself to focus on the cold, hard facts of the business, as he did when he visited those restaurants. He recognizes that the fear felt by millions of other investors is the very thing creating the bargain price. He is not immune to these psychological forces, but he has trained himself to recognize them, label them for what they are, cognitive biases, and then act in the opposite direction. This emotional discipline is not an innate talent. It is a learned skill, forged through decades of study and practice. To develop this skill, you need an applied mental model that you can use in the heat of the battle. The most effective one is the business owner versus stock renter framework. This is a mental exercise to force the separation between the business and its stock. A stock renter is how most people behave. They see themselves as temporary holders of a ticker symbol that goes up and down. Their emotional state is directly tied to the daily price fluctuations. They are, in effect, renting the stock, hoping to sell it to someone else at a higher price. A business owner, in contrast, sees a stock certificate as a deed of partial ownership in a real operating enterprise. Their focus is not on the daily quote, but on the long-term health and profitability of the business itself. Here is the blueprint for instilling this mindset. Step 1. Before a crisis, for every stock you own, you must write down on a piece of paper, in 3 simple sentences, what the business actually does to make money and why you believe it has a durable competitive advantage. For example, I own shares in Company X. It sells mission-critical software to large corporations. Its moat is high switching costs, as it would be too disruptive for clients to change providers. Step 2. When the market crashes and your portfolio is down 30%, take out that piece of paper. Read those sentences aloud. Step 3. Ask yourself one critical question. Has the source of this panic, the recession, the interest rate hike, the specific company crisis, fundamentally and permanently broken the business model I wrote down on this paper? In the case of American Express, the answer for Buffett was a resounding no. The salad oil scandal did not stop people from using travelers' checks. For most high-quality companies, a general market panic will have no bearing on their long-term moat. This simple exercise acts as a psychological circuit breaker. It yanks your focus away from the terrifying emotional input of the stock price, Mr. Market screaming, and regrounds your decision-making process in the rational, long-term reality of the business you own. This is a core component of a resilient stock market strategy, essential for both entrepreneurs and retail investors who want to survive and thrive through market volatility. The opposite path, the path of the 99%, is defined by 2 destructive behaviors: cathartic selling and the fear of catching a falling knife. Let's first understand the emotional experience of the average investor during a crash. Watching your net worth decline day after day is not just a financial event. It's a deeply painful psychological one. It feels like a relentless assault. This creates a powerful buildup of anxiety and stress, leading to a psychological need for catharsis, a release of that unbearable tension. Selling, even at a massive loss, provides that release. The moment you hit the sell button, the pain of watching the numbers go down stops. There is a fleeting, tragic sense of relief. You have taken control, you have done something. But this emotional catharsis comes at a devastating financial cost, as you lock in a permanent loss of capital at the worst possible moment. This is Mr. Market's madness taking over your own mind. The second trap is the fear of catching a falling knife. This afflicts the investors who manage to avoid panic selling but are too terrified to buy. They see a great company's stock fall from $100 to $70, and they think, "It's getting interesting." Then it falls to $50, and they think, "I'm scared it could go lower." Then it falls to $30, and their fear turns to paralysis. They tell themselves they will wait for the stock to find a bottom and start to turn around. But bottoms are only ever visible in the rearview mirror. By the time the stock has clearly turned around and is back at $50, the moment of maximum opportunity, the point of maximum pessimism has passed. They missed it, paralyzed by the fear that the stock could always go lower. These twin forces, the compulsion to sell to stop the pain and the paralysis that prevents buying, are why the majority of people are guaranteed to lose money during a crisis. They are playing Mr. Market's game by Mr. Market's emotional rules, a game they can never win. The direct financial connection of this pillar is the creation of a massive price-to-value discrepancy. A company's intrinsic value, the true worth of its future cash flows, is relatively stable. It does not get cut in half overnight because of a bad economic report, but its price, driven by Mr. Market's emotions, is wildly volatile. During a panic, the price can become completely unmoored from the underlying value. This is when valuation multiples compress dramatically. A stable, wonderful business that normally trades at a price-to-earnings PE ratio of 20 might suddenly be offered by Mr. Market at a PE of 10. The earnings power of the business hasn't changed, but the price you have to pay for that earnings power has been cut in half. Let's use the American Express example to quantify this. The market was pricing the stock as if there was a high probability of bankruptcy, a value of 0. Buffett's analysis concluded that the core business was worth far more than the current stock price, even if they had to pay the maximum possible legal damages. By buying at the point of peak pessimism, he was essentially getting double the long-term earnings power for every dollar he invested compared to the price a year earlier. This is the mechanism that generates explosive portfolio growth. When sentiment inevitably returns to normal, the PE multiple expands back to its historical average. So you benefit from two sources of return: the continued growth of the underlying business's earnings and the massive tailwind of the valuation multiple returning to a sane level. It's a double shot of capital gains, understanding that the price is what you pay and value is what you get, and that Mr. Market in his madness will often offer you immense value for a pittance of a price, is the very essence of crisis investing. You have your cash ready, you have your list of moated businesses, you've steeled your mind against the madness of Mr. Market. Now it's time for the final calculation before you act. You need to ensure that the price being offered is not just cheap, but ridiculously, irrefutably cheap. This is the fourth pillar, the foundational concept of all value investing, the margin of safety. Coined by Benjamin Graham, this is the principle that ties everything together. A margin of safety means buying an asset for a price that is so significantly below your conservative estimate of its intrinsic value that you are protected from bad luck, unforeseen events, or most importantly, errors in your own judgment. It is the investor's ultimate shock absorber. It is not enough for a great company to be on sale. The discount must be so profound that the investment becomes a heads I win, tails I don't lose much proposition. It's an intellectual and financial discipline of humility, an acknowledgement that the future is uncertain, and that even the most brilliant analysis can be wrong. Insisting on a massive margin of safety is what transforms a risky speculation into a sound investment and paves the way for extraordinary returns. The classic case study for margin of safety is Buffett's investment in the Washington Post Company in 1973. The setting was another period of market turmoil. The Nifty 50 bubble had just burst, and the country was mired in a brutal bear market and recession. Newspaper stocks, in particular, were seen as terrible investments, cyclical, capital-intensive, and facing uncertain futures. The Washington Post Company, despite its journalistic triumphs with the Pentagon Papers and the burgeoning Watergate scandal, was not immune. Its stock price had been crushed, falling by nearly half. At its low point, the entire public market valuation of the Washington Post Company was a mere $80 million. At this point, Buffett didn't just see a cheap stock. He saw an almost incomprehensible bargain. He applied the margin of safety principle by breaking the company down into its component parts and valuing them separately. First, there was the flagship newspaper, the Washington Post itself, which was a dominant franchise in a wealthy and powerful city. Buffett conservatively valued the paper alone as being worth more than the entire company's stock market capitalization. But that was just the beginning. The company also owned Newsweek magazine. It owned 4 major network-affiliated television stations in major markets like Miami and Hartford. In that era, broadcast television licenses were virtual licenses to print money. Buffett did his analysis and conservatively estimated the value of these television stations alone to be worth around $100 to $150 million. On top of that, there were other smaller assets. When he added it all up, his conservative estimate of the company's private market value, what a knowledgeable buyer would pay for the assets, was at least $400 million and perhaps as high as $500 million. And yet, Mr. Market, in his depressed state, was offering him the entire collection of assets for just $80 million. This was the margin of safety in its purest, most extreme form. Buffett was being offered the chance to buy a dollar's worth of prime, world-class media assets for just 20 cents. The discount was so large that it rendered the investment almost risk-free. Even if his valuation was wildly optimistic, even if the assets were only worth half of his estimate, say $200 million, he would still more than double his money. He proceeded to invest over $10 million, a huge sum for him at the time, and built a large stake in the company. That investment would go on to become one of his most successful ever, compounding into a position worth over $1 billion decades later. He wasn't a genius because he predicted the future of the newspaper industry. He was a genius because he insisted on a price that made the future irrelevant. The psychological reason why most investors fail to demand a margin of safety is overconfidence bias, combined with the planning fallacy. Overconfidence bias is the well-documented human tendency to be unjustifiably confident in the accuracy of our own judgments. We systematically overestimate our knowledge and our ability to predict the future. In investing, this manifests as an analyst or investor creating a very precise valuation for a stock, say $132.50 per share, and then believing that number to be truth. They then feel comfortable buying the stock at $120, believing they have a margin of safety. But their initial estimate was born of overconfidence and false precision. The planning fallacy is a specific type of overconfidence where we tend to underestimate the time, costs, and risks of future actions, while simultaneously overestimating the benefits. We create best-case scenario business plans and investment projections that fail to account for the friction and randomness of the real world. A company's new product launch will be a smash hit, its margin expansion will go off without a hitch, and its growth will continue in a straight line forever. The margin of safety is a direct psychological antidote to these biases. It is an act of enforced humility. When you demand to buy at a 50% discount to your conservative valuation, you are explicitly stating, "My valuation is probably wrong. I am probably overconfident." Unforeseen negative events are likely to occur. Therefore, I need this massive cushion to protect me from my own flawed human nature. It builds a buffer against the inherent uncertainty of the future. The overconfident investor who pays for a perfect future gets wiped out when that perfection fails to materialize. The humble investor who demands a margin of safety survives and thrives precisely because they planned for a world that is messy, unpredictable, and often disappointing. To apply this principle, the retail investor can use a practical mental model called the three-tier valuation method. This is a way to escape the trap of false precision and build a margin of safety into your process. Instead of trying to calculate a single, precise intrinsic value for a stock, you will calculate a range of values based on different scenarios. Step 1 is the asterisk TOR conservative case star. This is your anchor. In this scenario, you use deliberately pessimistic assumptions. Assume the company's revenue growth will be slow, its profit margins will shrink, and the overall economy will be weak. You can use a simple valuation method, like a discounted cash flow (DCF) model with very low growth rates, or a simple earnings power value calculation based on a recession level of earnings. This conservative valuation becomes your baseline. It's the number you believe the business is worth, even if things go badly. Step 2 is the asterisk base case 20. Here, you use what you believe to be the most realistic and probable assumptions. This is your best guess at the future, based on the company's history and current trajectory. This will naturally produce a higher valuation than the conservative case. Step 3 is the asterisk $10 optimistic case. In this scenario, you input best case assumptions. The new product is a huge success, the company gains market share, and margins expand significantly. This gives you the upside potential of the investment. The blueprint for action is simple and absolute. You only consider buying the stock when the market price falls significantly below your asterisk conservative case asterisk valuation. For example, if your conservative valuation is $100 per share, your base case is $130, and your optimistic case is $160, you do not start buying at $90. You wait until Mr. Market offers you the stock at $60 or $50. By doing this, you are ensuring that even if the pessimistic future you modeled comes to pass, you will likely still make a satisfactory return. This disciplined approach to value investing removes emotion and replaces it with a rigorous conservative process that is essential for long-term portfolio growth. The antithesis to this disciplined approach is the common and deadly mistake of paying for perfection. This is what happens to investors at the peak of a bull market. They find a wonderful company, a true wide-moat business with fantastic management and a long runway for growth. They fall in love with the company's story and its flawless track record. They observe its high growth rate, and, succumbing to the planning fallacy, they extrapolate that high growth rate into the distant future as if it were a law of physics. Because the company seems so perfect, they become willing to pay any price to own it. They'll happily buy the stock at a price-to-earnings ratio of 80, or 100, or even more. The problem is that a stock price at that level has no margin of safety. It is priced for perfection. The current stock price already assumes that the company will execute flawlessly for the next decade, that competition will never emerge, and that no recessions will occur. The slightest hiccup, a single missed quarterly earnings report, a new product that is merely good instead of revolutionary, a change in management, causes the narrative of perfection to shatter. And when the narrative shatters, the astronomical valuation collapses. The stock can fall 50% or more, not because the company has become a bad business, but because it has gone from being a perfect business to being merely an excellent one. The price paid had left no room for error, no margin for the realities of a competitive world. This is how investors can lose a fortune, even in the highest quality companies. They confuse a great business with a great investment. A great business only becomes a great investment when it can be purchased with a significant margin of safety. Ignoring this rule, driven by the excitement of a bull market and the fear of missing out, is one of the most reliable ways to experience the full destructive force of market volatility. The direct financial connection of the margin of safety is its ability to create a beautifully asymmetrical risk/reward profile for your investments. This is a core concept in sophisticated wealth management. An asymmetrical bet is one where the potential upside is many multiples of the potential downside. Insisting on a deep discount to intrinsic value mathematically engineers this asymmetry. Let's return to the Washington Post example to quantify this. Buffett's conservative valuation was $400 million. He was able to buy into the company at an $80 million valuation. Let's map out the possibilities. The potential upside: if he was right and the company was truly worth $400 million, he stood to make 5 times his money. The potential downside: what if he was wrong? What if his analysis was flawed and the company's assets were only worth half of his estimate, just $200 million? He would still more than double his money. What if he was catastrophically wrong and the company was only worth $100 million? He would still make a profit. In this scenario, the only way he could lose a significant amount of money was if the true value of the company was somehow even less than the fire sale price he was paying. A highly improbable outcome given the quality of the assets. The margin of safety created a situation where the upside was enormous and the downside was minimal. It skewed the odds of the investment so heavily in his favor that it was almost guaranteed to be profitable over time. This is the financial holy grail that all serious investors seek. You don't get rich by taking huge risks for huge rewards. You get rich by finding situations where you can take very small, quantifiable risks for the chance of huge rewards. The margin of safety is the single most effective tool for finding and exploiting those opportunities, allowing for massive capital gains while protecting you from permanent loss of capital. The final pillar is the culmination of all the others. The preparation is complete. The cash is ready, the watch list of great companies is set, the psychological storm of the market is raging, and you have identified a wonderful business trading at a massive discount to its intrinsic value. Now is the time for the fifth and final pillar: decisive action and patient holding. This pillar has 2 parts that seem contradictory but are in fact 2 sides of the same coin. First is the courage and conviction to act decisively when the opportunity of a lifetime presents itself. This is not the time for timidly dipping a toe in the water. It is the time to swing for the fences, to make a large, concentrated bet. The second part is the extreme, almost superhuman patience to hold that investment, to do nothing, for years or even decades, allowing the magic of compounding to do its work. It's a combination of brief moments of intense, concentrated activity, followed by long periods of deliberate, masterly inactivity. This is the final step that separates the theorist from the practitioner, and it is the ultimate engine of wealth creation. Perhaps no single investment in Buffett's career better exemplifies this 2-part pillar than his monumental purchase of Coca-Cola stock starting in 1988. The stage was set by the infamous market crash of October 19, 1987, known as Black Monday, when the Dow Jones Industrial Average fell by over 22% in a single day. In the months that followed, the market remained nervous and volatile. Coca-Cola, despite being one of the world's most iconic companies, saw its stock languish. Buffett had been studying Coca-Cola for decades. He was a lifelong consumer of its products, famously drinking at least 5 Cokes a day. But his interest was far from casual. He had meticulously analyzed its business model. He saw a company with a simple, understandable product. He saw a global distribution system that was a marvel of logistics. Most importantly, he saw an economic moat of unparalleled size and strength, the Coca-Cola brand, arguably the most powerful intangible asset on the planet. He saw its incredible economics. The company sold a syrup concentrate for pennies, which was then mixed with carbonated water and sold for dollars, generating immense returns on capital. After the 1987 crash, Mr. Market offered him a price that, while not as cheap as some of his earlier cigar-butt investments, represented a fair price for this truly wonderful business. And so, he acted. But he didn't just buy a few shares, he acted with overwhelming force and decisiveness. Over a period of several months in 1988 and 1989, Berkshire Hathaway bought shares of Coca-Cola aggressively, ultimately investing over $1 billion. At the time, this was a staggering sum, representing a huge portion of Berkshire's portfolio. It was a massive, concentrated bet on the long-term future of a single company. This was the decisive action. Then came the second part, the patient holding. Once the position was built, Buffett's work was essentially done. He put the stock certificates in a metaphorical safe and did nothing. He held through the recession of the early 1990s. He held through the dot-com bubble and bust. He held through the 9/11 attacks. He held through the 2008 financial crisis. He simply let this phenomenal business continue to grow its earnings and expand its global reach. That initial $1 billion investment has since grown to be worth well over $20 billion, not including the tens of billions of dollars in dividends that Berkshire has received and reinvested over the past 3 decades. The Coca-Cola story is the ultimate testament to the power of finding a great opportunity, betting big, and then having the patience to let the outcome play out over a lifetime. The psychological battle at play in this final pillar is the conflict between action bias and omission bias. For most of our daily lives, especially in a professional setting, we are governed by an action bias. We feel a constant pressure to do something. We need to be seen as busy, as making decisions, as taking action. In investing, this bias is disastrous. It leads to constant trading, churning a portfolio, trying to time the market, and racking up transaction costs and taxes. It's the feeling that you should always be tweaking and optimizing. However, during a crisis, when the stakes are highest and the most important decisions need to be made, our psychology often flips to its opposite, omission bias. This is the tendency to judge harmful actions as worse or less moral than equally harmful inactions or omissions. In investing, this means the fear of making a decision that turns out to be wrong, a sin of commission, is far more powerful than the fear of failing to make a decision that would have been right, a sin of omission. The pain of buying a stock that then falls another 20% feels much worse than the regret of not buying a stock that then doubles. This omission bias leads to analysis paralysis at the exact moment of maximum opportunity. Buffett's genius is in his ability to master both biases. He spends 99% of his time deliberately indulging in omission bias, doing nothing, patiently waiting, resisting the urge to act. But in that 1% of the time when a fat pitch comes right down the middle of the plate, a wonderful business at a wonderful price, he completely overrides omission bias and takes massive, decisive action. He understands that in investing, you don't get paid for activity. You get paid for being right, and for being right in a big way, a few times in your life. The applied mental model for this is what Buffett calls the punch card investment philosophy. It's a simple but incredibly powerful visualization exercise. Imagine that at the beginning of your investment career, you are handed a punch card with only 20 punches on it. Each time you make an investment decision, buying a new stock, you have to use one of your punches. Once you have used all 20 punches, you can't make any more new investments for the rest of your life. This mental framework completely changes your behavior. Here is the blueprint for how to use it. First, it forces extreme selectivity. You would not waste one of your precious 20 punches on a speculative, mediocre idea. You would reserve them only for your absolute best ideas, the ones you have researched exhaustively and have the highest conviction in. This completely eliminates casual speculation and forces you to focus only on A-plus opportunities. Second, when you do find an investment that is worthy of a punch, it encourages you to act decisively. You wouldn't use a once-in-a-lifetime punch on a tiny, insignificant position. If the idea is good enough for a punch, it's good enough to be a meaningful part of your portfolio. It forces you to bet big on your best ideas. Third, And perhaps most importantly, it promotes patient holding. Once you've punched the card, you are mentally predisposed to hold that position for a very, very long time. You don't want to waste another punch selling it just to buy something else that might be marginally better. Your default action becomes inaction. This punch card model is a brilliant antidote to the hyperactive short-term mentality of modern markets. It fosters the concentration, selectivity, and long-term perspective that are the hallmarks of all great investors, and is an essential tool for entrepreneurs and any retail investor aiming for significant portfolio growth. The antithesis to this approach is a combination of two common mistakes that destroy the portfolios of average investors: diversification and, quote, watering the weeds. Diversification, a term coined by the legendary investor Peter Lynch, is the practice of owning so many different stocks that your portfolio becomes an expensive, closet index fund. An investor might own 50 or 100 different stocks in tiny amounts, thinking they are being safe and diversified. In reality, they have no deep knowledge of any of their holdings. Their best ideas are starved of capital, and their impact is diluted by dozens of mediocre ones. They lack the conviction to use the punch card and bet big on what they know best. The second mistake is even worse: watering the weeds and cutting the flowers. This is a behavior driven by a psychological bias called the disposition effect. Investors have a strong tendency to sell their winning stocks too early to lock in a profit, while holding on to their losing stocks in the hope that they will come back to even. It feels good to take a profit, and it feels painful to realize a loss. The result is that their portfolios over time become concentrated in their worst-performing assets, the weeds, while they have systematically sold off their best-performing assets, the flowers. This is the exact opposite of what a smart investor or a smart business manager would do. Buffett's approach is to do the reverse. Add to your winners when they are still reasonably priced, and be ruthless in cutting your rare mistakes. By concentrating his capital in a few great ideas, and then letting those winners run for decades, he harnesses the full, explosive power of compounding. The average investor, through diversification and watering the weeds, guarantees that they will never experience it. And this brings us to the ultimate direct financial connection, the almost mystical power of long-term compounding. This is the final payoff, the true source of all great fortunes. The decisive action during a crisis creates the opportunity, but it is the patient holding that unlocks the wealth. Let's look at the math of the Coca-Cola investment. That initial $1.02 billion investment bought Berkshire a stake that, due to buybacks, now represents over 9% of the company. The market value of that stake today fluctuates, but it's in the realm of $25 billion. That is a staggering capital gain. But it's only half the story. The real magic is in the dividends. In 1988, Coca-Cola's annual dividend was a few cents per share. Today, it is many multiples of that. Berkshire's initial investment now pays it over $700 million in cash dividends every single year. Think about that. Berkshire now receives back in cash almost 70% of its entire initial investment every single year, without selling a single share. That is the power of buying a growing business and holding it. The compounding isn't just in the stock price, it's in the growing stream of cash flow that the investment produces. When you compare this result to the S&P 500 over the same period, the outperformance is monumental. This is what transforms a portfolio into a legacy. It's the understanding that the real money is not made in the buying or the selling. It is made in the waiting. It is the reward for having the discipline to build a fortress of liquidity, the wisdom to identify enduring quality, the courage to act against the herd, the humility to demand a margin of safety, and finally, the profound patience to let time work its magic. That is the complete playbook. That is how a market crash becomes the greatest wealth-building opportunity of your life. You have just been given a powerful and complete playbook, a 5-part system for transforming the single greatest fear in finance into your single greatest advantage. You've learned to build a fortress of liquidity so you have the ammunition when it matters most. You've learned the moat mentality, so you know which high-quality businesses to target. You've learned to master the madness of Mr. Market, turning his panic into your profit. You've learned to demand a margin of safety, building a cushion against error and uncertainty. And finally, you've learned the necessity of decisive action and patient holding, the final combination that unlocks the explosive power of compounding. This is not just theory. It is a practical, battle-tested blueprint that has created one of the greatest fortunes in human history. You now possess a mental tool of immense power. But it's crucial to understand that this playbook, this external strategy for engaging with the market, is only half of the equation. It's the what to do. It is powered by something deeper, an internal operating system of thought, a set of non-negotiable principles and character traits that allow for its flawless execution. Knowing the playbook is one thing. Having the unbreakable emotional and intellectual discipline to actually use it when the world is on fire is something else entirely. You've just mastered the tactics, but the foundation of true, lasting success is in the core philosophy. The video that is now appearing on your screen is the bridge to that deeper understanding. It is the next piece of the map. It moves beyond the external actions and reveals the internal architecture of the investing mind. It's the link that connects the strategy you just learned to the mindset that makes it all possible. This journey does not end with a single playbook. You have spent this time acquiring a powerful financial weapon, but a weapon is useless without the mental fortitude to wield it effectively under extreme pressure. The choice you have right now is simple. You can stop here with the tactics, or you can click on that video and begin the work of forging the unbreakable mindset of a true investor. The path to financial freedom is not a single step. It is a continuous process of intellectual ascent. Complete your mental arsenal. Continue the climb.